that almost all of it back, whether that's through deals or some sort of capitulation from one side or the other. There's just no realistic world where we're going to see 145% tariffs on China for years. It's not feasible. And the government is out there in private meetings saying that. Besson's saying that straight up. So, we could see some exemptions, but ultimately, if you're Apple, you just don't want this to go on for too long. And again, it is the demand thing. And then also, there's been talk about the company moving to India to manufacture. Sure. That's not realistic either. They're going to have to, because Tim Cook has talked about this explicitly. There's knowledge within China, knowledge about the tooling. It's not just low-cost labor. It's the actual tooling, it's the expertise, it's the supply chain within China that you just can't quickly switch over to India. There's been some move to India, but again, it's not going to happen overnight.
What you got out of Alphabet, did it help you think about these in any way differently than you otherwise would have?
Well, for Alphabet, Q1, again, like we were talking about earlier, there's going to be a lot of information about Q1 that isn't going to necessarily be a read-through to the next quarter because we haven't had a Liberation Day in Q1. But that being said, I'm very impressed with Google. I mean, Google's got a profitable, growing ad business. Search isn't dead. A couple of years ago, people were talking about how it's the end of search and Sundar Pichai should be fired. And now it's very clear that search ads are extremely healthy and search is growing even as ChatGPT grows, which suggests that it's not one or the other. There's uses for each. And if you invest in Alphabet, you have search, you have Waymo, you have the investment in Anthropic, and you have DeepMind, which for my money is one of the best AI labs out there that is going to continue to ship and push the cutting edge forward.
I'm surprised you didn't talk about Meta as being so top of mind because of the regulatory issues and the overhang there. We're going to get a chance to hear, not in a courtroom from Mark Zuckerberg, who's going to talk about what the issues might be and how they might be resolved in the future.
So I was in Washington, D.C. over the weekend for the White House Correspondents' Dinner, not the dinner itself, but some of the parties around it. And I asked everybody what was going on with big tech because it's Meta's in court right now and Google's just lost a couple cases. And the sense I got there was Meta just does not have enough friends in Washington, D.C. One way or the other, Mark Zuckerberg and co. have alienated many lawmakers, many lobbyists, many supporters. And right now they're in court. And it doesn't seem like they were quite as careful as Google was. A lot of the sloppy emails are coming out. So with Meta, you have to pay attention to this. We've already seen Google has lost. And I think they have like one appeal left, and then they could be split up should the judge decide to go that route. So you're right. This is a very big deal for Meta. And Meta also has the big tariff situation because it has billions of dollars coming into its ad product through Chinese retailers. And advertising, it's an advertising business dependent on advertising as a whole. So to me, that's the immediate concern. Because if we go into recession, and a lot of people are saying that's where we're heading, the first thing that happens is an advertising pullback. In a recession, advertising marketing dollars, gone. If that happens, Meta is not as strictly performance as a company like Google, which is doing well. It could be a very big problem for them. So yeah, I definitely want to hear what Mark Zuckerberg has to say.
All right, we appreciate hearing what you have to say. Alex Kantrowitz, big technology and a CNBC contributor. Thank you very much.
Thank you.
We are getting some news out of Washington today. Emily Wilkins has that for us. Emily?
Hey. Well, House Republicans are planning to move forward on a provision that would consolidate antitrust, taking it out of the hands of the FTC and putting it solely within the Department of Justice. Now, this provision that they're going to be looking at and voting on come Wednesday, it's a part of the much, much bigger plan for Trump's one big, beautiful bill. Congress is now working on the actual policy details of this legislation. And while the idea of consolidating antitrust within the Department of Justice has been around for a while, it recently did get a boost from Elon Musk, who said it would be a good idea, and it's something that lawmakers have generally been behind. Of course, we're now only at the start of the process of putting really the meat on the bones of this one big, beautiful proposal. So, of course, long way to go to see if it actually gets across the finish line, but something we now know that Republicans are putting forward onto the table.
The key word that you used in terms of, at least to me, is solely. So you're suggesting that they would take the FTC out of the antitrust process altogether, even though both the FTC and the DOJ are at the direction, at least of the president. Currently, the FTC is still an independent agency in which the DOJ is not. That's the big difference here.
And a lot of this goes back, yes, I mean, a lot of this goes also to funding, to the funding that Congress is going to allocate. And so basically what this bill says is, hey, everything the FTC has with antitrust right now, the employees, the equipment, all of that needs to move over to the DOJ. And of course, this is coming as there's a lot of questions about cost cutting, a lot of questions about, I think, government oversight, regulation. So a lot that really is at play here as Republicans are considering making this move.
Interesting, very interesting potential development. Emily, thank you. Emily Wilkins in Washington for us. We do have more breaking news from D.C., from the Treasury. And for that, we go to Megan Casella with those details. Megan?
Hey, Scott, so the Treasury Department is out just now with its latest borrowing forecast. They're estimating they'll need to borrow $514 billion for the second quarter. Now, that is $391 billion higher than the initial forecast from February. Treasury says that's largely due to a lower than expected cash balance to start the quarter. They ended Q1 with just $406 billion in cash on hand when they had expected $850 billion. Agency officials told me that was because of debt limit constraints. Those have forced them to spend more cash rather than keep a week's worth of funding needs on hand in cash like they typically would. And Scott, Wall Street had been expecting the borrowing estimates to rise, but $514 billion is higher than any of the forecasts I had seen. So that need for further borrowing is putting a little pressure on yields. The 10-year is around its lows for the day, about 4.2%. Now, looking ahead, Treasury says it expects to borrow $554 billion for the July through September quarter and to beef up that account balance to end the quarter with $850 billion in cash. But again, that could change significantly depending on what happens with the debt limit in the coming months. On Wednesday morning, Scott, we'll get more details on the auction sizes expected here and the breakdown in tenors all along the curve. In recent years, as you know, that release has had the greater impact on the market than this one. Scott?
Was there, Megan, any expectation at all that any of the tariff revenue that's coming in now would potentially make for a smaller number than we just got?
It's possible we see that in the future. I think it's a little too early to see that now. Agency officials were asked about that, and they said all of their forecasts, while they don't get into individual line items, do take into account the forecasted tariff revenue. But that $554 billion for the next quarter, that takes into account that there will be some increase in tariff revenue. They still think they would have to borrow that much.
All right, Megan, thanks for that. Megan Casella outside the White House, as you see. Let's bring in Anastasia Amoroso now of iCapital and Lauren Goodwin of New York Life Investments. Good to have you both with us. What are we supposed to do with the markets now? You know, we've got about 50% of the losses back from the February high to the post-Liberation Day low. Is there momentum still? Would you be more positive on stocks at currently or
yeah,
no?
Unfortunately, we're at this juncture where we can argue either side of the equation. I'm going to try to do that. You know, I think short-term patience is still going to be required, although I will say the fundamentals, the catalysts, and the technicals are starting to be better aligned. So let me just expand on that a little bit. You know, I think last week was actually pretty pivotal, Scott, because, you know, first of all, we got some positive technicals and the fact that we have 61% of stocks that were advancing at some point on Thursday or Friday. So that snapback is very positive. And then also, Scott, we're now coming towards the tail end of the earnings reporting season, which means companies will be able to execute their buyback. So the largest buyer, which is the corporate, is going to be back in the market. So I like that. But of course, as I talked about before last week, it's not just about the technicals. That alone does not move the markets. It's about the catalysts. And the fact that we have, I would say, 3 categories of catalysts that are lining up positively. You've got trade deals. Maybe we're going to hear more on that front this week. We've got rate cuts. The Fed is now gone, to deliberate ahead of the FOMC meeting. But I think the consensus must be building for some sort of a rate cut come June, if not before. And then, of course, we also got big tech earnings, which I actually think if you extrapolate Alphabet into this week, could be positive. So I think near term, I could see that momentum from last week continue.
I feel like that's kind of the consensus, Laura, right now, that, from a tactical standpoint, bullish, but bigger picture. From a technical standpoint, maybe bullish, but from a bigger picture, fundamentally, it's really anybody's guess. That's like what Tony Pasquarello Goldman was talking about today, that the technical factors have finally tilted positive, but the fundamentals, okay, all bets are off.
Yeah, I think that's right. Investors are still looking for more clarity from the macroeconomic backdrop, and they're not going to get it. Even in a week like this, where we're finally starting to get some hard economic data that could give an anchor around some of the rapidly deteriorating business and consumer confidence, we're going to see a mixed bag of economic outcomes where consumers and businesses are pulling purchases forward to get ahead of tariffs. Does that mean things are as good as they look? Does it not? Investors really aren't certain. But I think what we can take from this environment are a couple of factors. First, alongside the volatility, we're starting to see asset correlations, the way that different asset classes would typically behave together, break a little bit. We're also seeing different parts of the world, you brought up structural themes, invest in a different way than they have in the past. That means for an investor that's facing a lot of uncertainty, you might actually say, even sitting on my hands, I might want to make some changes to adapt to some of those long-term themes.
Jobs report on Friday looms especially large. I mean, you could easily make the case that just given the questions that exist about the state of the economy, the state of the trade war, and what sort of hiring practices are going to be on the receiving end, if you will, of all of that uncertainty, that you get a pretty good read, even though it's a lagging indicator, because it's for the month of April. Liberation Day was a while ago at this point. You get a pretty good read.
Yeah. I would argue, Scott, this is probably the most important data point that we get is on the labor market front versus some of the Mag 7 earnings. And the reason for that is if you look at everything else out there, like inflation, for example, which is forecast to be 2.6% year over year. If you look at consumer confidence, it has been in shambles. If you look at business sentiment, it's really all of that is lining up for a rate cut. What's not yet made the Fed think they are due for a rate cut is the labor market. But if you see the number of job openings on Wednesday weekend, if you see some cracks form in the initial jobless claims, which, by the way, I would expect, given what we're hearing about the shipping channel, and if all of that gets solidified with weaker than expected payrolls report, I think that really solidifies the case that the Fed needs to move. And by the way, given what we just heard about the budget deficit and the funding gap, I think this is the playbook of the administration is raise the tariff revenue. In the meantime, get the economy to be in such a shape that warrants a rate cut.
It's interesting that, now we have the Dow up 100. It's been a pretty volatile tape. Not a huge range, but volatile nonetheless. Is this the environment we're living in for a while now?
It's absolutely the environment that we're living in. In fact, I think the 10% that we've moved up, 10, 12% from the lows, puts us in a position where volatility is, in fact, more likely to operate on both sides. And I think that's true not only for the equity market, but also for the bond market as well. When we think about the 10-year Treasury yield, I expect a wide range of outcomes between 4 and 5% over the next couple of months. And when it comes to some of the data and the evidence that we're looking at this week in regards to that, I completely agree with Anastasia's analysis on what the job market might bring. I don't think we're going to see it yet. I don't think we're going to see real evidence of change yet, because if I think about in the portfolio companies we're talking to, the businesses that we're talking to, trying to get a sense of what's going on, there's so much uncertainty that you're not even sure that you should fire yet. You might not be hiring, but you're not making big changes to your business, especially only a few years after the pandemic, where hiring and sort of repositioning folks was so challenging. And so where I'm particularly looking for evidence is actually in earnings growth, because if we start to see a slowdown in earnings growth relative to recent history, that might tell us that employers are starting to make changes in a way that might not show up in the job creation.
I mean, at this point, isn't that kind of your base case? In other words, how could we not end up seeing changes for earnings growth? I think we already are and expect even more, no?
That's right. Especially, I mean, the cyclical backdrop was heading there anyway. You're absolutely right. And so I would expect to see more over the next couple of months. Whether we see that on Friday, I'm not so certain.
What's a better bargain, so to speak, right now? Bonds or stocks? Because I've had some people in the last week take a look at where bond yields had gone and say this is an incredible opportunity for treasuries. What do you think?
Look, I can make a case for both. And, first of all, if you're really trying to hedge a recessionary outcome in the portfolio, and by the way, we may need to do that because the second quarter is going to be all about the realization of these negative impacts. Bond yields typically move lower and they move more than they already have. So you could see them move by 50 or 100 basis points more. So in which case that is a great entry point. But at the same time, for long-term investors, when I look at the multiple, which has been de-risked for a lot of the high growth names, and if I look at some of the technical indicators out there, and if I think about the percent of bearish sentiment, all of that sets up a pretty attractive entry point for investors. I would just caution Scott and say it's not a moment when you have to make this change. It's a period of adjustment, and that's what the second quarter is all about.
It is interesting nonetheless, Lauren, that we went from, obsessed and fixated on the fact that bond yields were backing up And now we're going to start watching yields going down, and we're going to say it's for the wrong reason because now it's because of worries about the economy. So we've, in a week, changed our whole perspective perhaps on one part of this fast-changing market, right?
Yeah, absolutely. I mean, look, bond yields can move for three reasons. The path of the Fed funds rate over that tenor, so let's call it 10 years, has changed. We're not seeing a lot of expectation on that front. Inflation expectations, obviously more volatile, even a little bit on the long end. And then the term premium. And the term premium is all sorts of supply and demand factors, and this is where we're starting to see correlations in the market break down. And when I see that type of behavior, volatility in the 10-year and differences in volatility between the 10-year, oil, gold, the US dollar, that's when I start to think that in addition to some of the ideas that Anastasia is sharing with us, we need to rethink just overall asset class diversification. How is a portfolio constructed? And so in addition to focusing on quality in an equity portfolio, acknowledging that we need to be tactical and prepared potentially for recession risk, I'm also looking at preparation for inflation risk, having a little bit of gold, real estate, inflation-aware asset classes, and a sector balance that's focused on some of the structural themes around digitization, electrification, alongside these asset classes. Where I'm not taking risk is duration.
Yeah. 60-40 seems like yesterday, so to speak. Like we need to talk more about that, and we will. Ladies, thanks for being here.
Good to see you.
All right, we're just getting started here on Closing Bell. Up next, Ed Yardeni's back. We get his read on Q1 earnings, what the growing dovish faction at the Fed could mean for rates in the months ahead. There's a meeting coming up. We're live at the Stock Exchange, New York Stock Exchange. You're watching Closing Bell on CNBC.
Or download the app.
All right, welcome back. This week's jobs report could be pivotal in understanding what the Fed's next move might be, especially with concerns over a slowing economy intensifying lately. Let's bring in Yardeni Research President Ed Yardeni for more on what he's watching. Welcome back. It's good to see you.
Thank you, Scott.
We'll get to the Fed in a second, but just your view right now of this market, which has rallied back pretty hard. Now what?
Well, I think the market's been choppy since the beginning of the year, mostly choppy to the downside. Now maybe we're going to get, well, in the past week or so, we've had a lot of chop to the upside. I think it's going to remain choppy. I think the trade issue is still going to hang over the market through early July. Certainly the issue with regards to China and what that implies about price inflation in the United States and empty shelves in stores. So I think at this point, choppy is probably the way to describe it. But I think the market may actually be doing what it's supposed to be doing, and that is looking out beyond the next week or month. I think it's actually starting to think about 2026 and anticipating that a lot of the craziness will be behind us.
I mean, you really think any part of this market activity that we've witnessed in the move back up from the lows has to do with that? I just feel like it was oversold. We're coming back. We're not sure what's going on. And we can't even look, 5 yards ahead of us. I have a hard time believing we're looking 10 months.
No, it's a good question. Look, I think that historically corrections tend to occur when investors worry about recession that doesn't happen. And bear markets occur when the recession actually happens. I think that we've seen a correction. I think we made the low on April 8th, the day before the postponement of Liberation Day for 90 days. I think the market at that point started to anticipate that maybe there wouldn't be a recession. There might be a slowdown in the second half of the year. But to the extent that this turns out to be a correction, which is what I think it's turning out to be, then I think the market's confirming my view that we're going to get a soft patch in the second half of the year and an improvement in 2026. So, look, I think the market does look forward. It does look ahead. People look at valuation multiples and how they've come down and ask themselves, well, now that things are a lot cheaper, does this make sense relative to my outlook for the next couple of years?
Maybe we're just looking ahead and anticipating rate cuts. Maybe that's why bond yields have finally started going lower in anticipation of that, while the stock market's just going to see what the data is, see what the earnings are, and then listen to Powell and company. Yeah,
well, there's certainly a debate between Powell and company and some of the dissidents or dissenters that seem to be coming to the fore. Governor Christopher Waller has indicated that he's ready to lower interest rates sooner rather than later, whereas Powell and company have expressed the view that they're in no rush to lower interest rates at all. And I think they still have an inflation issue. I mean, we just had the Dallas Fed data come out today. We now had 5 of the regional business surveys, and they show a very big decline, weakness in the activities index. But on the other hand, the price index is really picking up. So it's a stagflationary environment. And I think the Fed has to be very concerned about fueling inflation. So I don't think they're going to be in a rush to lower rates. And that may, again, add to the choppiness. The market's had a history over the past few years, Scott, as you know, of anticipating rate cuts that don't happen.
And it sounds to me like you don't think they should cut rates.
I don't think they should cut rates because I think they've got an inflation problem. And that inflation problem is going to become increasingly visible in coming months. I mean, the PCED inflation number that'll come out on Wednesday, it looks like it's going to be great. It's going to be like 0, but I think we all have to anticipate that given some of the other pricing indicators, particularly for the regional business surveys and the national PMIs, purchasing managers indexes, all those prices paid, prices received indexes are showing upward momentum.
I know, but how can you be reasonably constructive on the market, even beyond the next few weeks, and use stagflation in the very same conversation?
Well, I think that stagflation is going to be a fairly short-term phenomenon. I think the inflationary pressures from tariffs is to a large extent going to be a one-time phenomenon. It's the prices go up and then they kind of stay up. So I don't think that's going to be a persistent inflation problem. And meanwhile, while the stagflation scenario is getting support from the regional business surveys. The consumer, which really accounts for a great deal of the economic activity, looks to be still spending quite well. The Red Book retail sales number on a weekly basis is up over 7% on a year-over-year basis, for example.
You think the bond market problems are largely over? I use problems in quotes, of course.
Yeah.
But it certainly did get the stock market's attention, and people like you, I know, who watch both closely.
Yeah, absolutely. I didn't really freak out the way the market seemed to freak out. I mean, we did go from 4 to 4.5% in a very short period of time, and a lot of that had to do with this the spreads that people were playing in the hedge fund community. But we got all the way up to 4.5%, which is kind of where we think rates should be. In our mind, the bond yield is normal at 4.5%, and the economy has demonstrated that it's got no problems at all growing in a 4.5% bond environment.
Well, of course, the tariffs notwithstanding, it remains to be seen. We'll talk to you again soon. Yeah,
absolutely.
Ed, thanks. Ed Yardeni. All right. Coming up, semis slipping in today's session. That sector giving back some of the gains from the past few days. We'll drill down on that next.
.com.
All right, chip stocks on track to snap a 4-day win streak, with that space being dragged down today by NVIDIA and some others. Christina Partsinevelos has more on those moves. They're big, too.
They're big, but I'll be optimistic they're pulling off their lows. But like you said, still broadly in the red. Looking at the SMH ETF, I often use that because it's a great barometer for the overall sector. It's an ETF, and it's finally, like you said, turning negative after 4 straight days of gains. Intel, the lone bright spot, up about 2.5% as investors really are positioning ahead of tomorrow's Foundry Day. The CEO will be presenting at noon Eastern, and the street isn't really setting expectations quite high, but any meaningful updates on their advanced manufacturing technology, 18A, or new customer wins for their foundry business could really give shares a nice boost. On the downside, what you alluded to, Scott, NVIDIA, Broadcom, Marvell are all feeling the pressure from 2 China developments. Huawei is apparently getting ready to test its most powerful AI chip to date. The company claims it could rival NVIDIA's H100, or I should say Wall Street Journal claims that, though it's still largely unproven. Perhaps more interesting for the industry is Chinese media really indicating over the last 48 hours that AI from DeepSeek's next model might be built entirely on Huawei's silicon, potentially demonstrating that advanced AI models can be developed on less powerful chips, something we saw with the first version, which is a notable technical shift rather than a direct revenue threat to NVIDIA, whose China exposure has been diminishing. Nonetheless, it is hurting the NVIDIA bull narrative. Scott?
All right, Christina, thank you. Christina Partsinevelos. Coming up next, we track the biggest movers into this close. Pippa Stevens is standing by with that for us today. Hi, Pippa.
Hey, Scott. One consumer stock is pedaling higher after a bullish call. We've got the name to watch coming up next.
can save.
We're 15 from the bell. Let's get back now to Pippa Stevens for a look at the stocks that she's watching. Tell us.
Peloton is in the green after Truist upgraded the stock to a buy, saying the path to growth and sustained profitability is getting clearer with improving fundamentals, supporting a gradual recovery for the equity. The firm's $11 price target, which implies 70% upside, remains unchanged. And Plug Power is surging more than 20% after signing a secured credit facility for $525 million, while also reporting preliminary Q1 results. The company said it has no plans for additional equity raises this year after cost-cutting efforts and recent financing. The shares, though, still down 50% this year. Scott?
All right, Pippa, thank you. Pippa Stevens. Still ahead, NXP earnings coming in overtime. Shares are up more than 10% in just the past week. We're going to break down the numbers you need to watch for when the bell comes right back. All right, coming up next, more big earnings out after the bell tonight, including a key read on the material space when Nucor reports that and much more inside the market zone. We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day, plus two earnings reports we are watching in OT. Christina Partsenevelos on NXP and Pippa Stevens on Nucor. Mike, I begin with you. Nice little move here into the close. We are green across the board for the moment.
Yes, sort of a little bit of upward drift, which I think is probably welcome. The big takeaway to me today is that volatility has drained away to some degree for now. You have a lot of dispersion within the market. So half a stock's up, half stock's down. It's not one of these all in, all out type of days. In general, we're in this zone where even if people are bearish and they think this is nothing but a bear market bounce, they're tactically allowing for the market to kind of give it a little more lift, right? You get up toward the April 2nd levels or 5,700 or whatever. So there's not a lot of, I think, motivated people to say, uh-oh, it's time to sell this thing here. So, I feel like you're in this sort of in-between period of it's no longer oversold. Everybody hates the market. It's looking like disaster's priced in, but it's also not like the market's earned back the fact that it's an uptrend. So that's why we drift back and forth.
I still feel like we're obviously a little on edge. We're hopeful of some progression on trade deals, but we're also wary, frankly, of the fact, people are talking about this, that the Commerce Secretary, Lutnick, is on CNBC tomorrow afternoon
Absolutely.
at 2 o'clock.
These are the things you actually have to kind of handicap and have some kind of a game theory sense of what it means. So I do think you're right. We still have this hope that we're going to have incremental movement on relaxation of what's out there for trade, but it has to at some point get beyond hope. And that's, I don't know if that's today or if that's in another 3% higher when it's really going to start to matter that you have some kind of line of sight to an end to this, or
some are speculating
some firm policy.
Whether, maybe we get an announcement on a deal with somebody tomorrow morning. We'll see. Obviously. Christina on NXP. Speaking of we'll see, tonight after the bell.
Yeah, and we may have a line of sight. We'll likely see the early stages of recovery in both auto and industrial markets, and that's pretty good for NXPI. Since the auto segment makes up nearly 60% of their business, their software-defined vehicle products, radar systems, and battery management systems actually represent 40% of their auto sales, and all of those do have impressive growth trajectories. You also have inventory levels that have returned to normal and gross margins that are likely to bottom this quarter, according to analysts. Analog competitor Texas Instruments recently shed some light on customer behavior with their earnings report not too long ago. They mentioned seeing more orders come in. And although customers weren't really telling them why they were buying more, they assume the inventory is building because of market anxiety. We might see some similar dynamics with NXP, potentially boosting near-term results so that demand pull-through, though tariff worries could make the second half of the year less predictable, Scott.
Yeah, real demand versus pull-forward demand. There are really two different things. We'll see. And I'm glad you raised that point. Christina, thank you. That's Christina Partsinevelos. Nucor is the other one, Pippa Stevens, and we need to talk trade and tariffs and the impact on material stocks like this one.
That's right, Scott. A lot to watch here. Nucor is modestly higher ahead of its print, which does come after the company issued Q1 EPS guidance back in March that did disappoint the street, saying results would be impacted by lower average selling prices. Analysts will be looking for an update on order activity, as well as the overall steel demand outlook for the year amid increased uncertainty related to tariffs and trade policies. Still, UBS is saying the sell-off creates opportunity, upgrading the stock to a buy rating in March. The firm forecasts prices falling in the second half of the year after near-term panic buying subsides, but remains confident in the medium-term price outlook for steel. Scott?
All right, Pippa, thank you. 2-minute warning. We just heard the sound effect there. The animation has rolled, and Mike Santoli's ready for his last word. I tell you, we've had some buying in the NASDAQ here.
Yes.
Tesla was red. It's now green. Apple is green. Meta's green. Nvidia's certainly well better than it was earlier today, too.
It's picking up. What was going on last week, too, is that those stocks, obviously, they went down more than the rest of the market, so there has been a big rebound effect. But it underscores the retail bid has not gone away.
No, it's a story that was talked about earlier today, too.
Yes. And so this is a lot of ways to quantify it. And I really puzzle over it. Over the weekend, I was writing about how will this be the first severe correction where retail didn't blink and they were rewarded immediately for it? Maybe, because institutions really did de-risk, and now they are actually starting to get back in and getting their exposures up, and volatility coming down kind of creates a self-sustaining thing because their models say we can own more of this. But they're buying, if they're in the individual stocks, it is still the Teslas, the Nvidias, and then, even some of the more speculative stuff that started to move. Some SPACs were moving on Friday, and there was a massive round of call buying. So I don't know if that mitigates how much, kind of a reservoir of skepticism we have to build from here to get higher, but it's worth noting that that's animating this market a bit.
Well, it leads us to the jobs report, obviously, on Friday. Some have talked today about retail's resilience being tied so heavily to the fact that the labor market's been still resilient.
It hasn't cracked, absolutely. So we'll see. There's a window when the economy can get through if you do get rollback of tariffs. We don't know how wide that window is.
We've thought it out pretty well. Thank you, Mike. We've thought it out pretty well today. Looks like we'll finish mostly green. NASDAQ's going to go right to the finish into overtime with Morgan and John.
That bell marks the end of regulation. Goldman Sachs Asset Management ringing the closing bell at the New York Stock Exchange. Payoneer doing the honors at the NASDAQ. And a late session rally pushing the major averages higher after spending much of the day modestly in the red. The NASDAQ had been down nearly 1.5% at the lows. That's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan.
Well, it's the biggest week of earnings season, and overtime results get underway this hour with the numbers from NXP Semiconductors, Cadence Design Systems, F5, and Nucor. We will bring you all of the headlines and an interview with F5 CEO ahead of the call.
And also ahead, emerging markets expert Mark Mobius tells us where he's finding opportunity in the world right now.
And BlackRock's Gargi Chowdhury just published her spring outlook. She will join us with her expectations for equities, fixed income, gold, and much more.
Let's talk markets, though. Joining us now is Scott Wren of Wells Fargo Investment Institute and Dana D'Auria of Envestnet. Guys, welcome. Dana, we got a big week of earnings this week, but also a big week of data. At this point, which do you expect to give you more insight into how to position, the micro or the macro?
Well, I certainly think from an earnings report perspective, anyone who's willing to actually do a forecast, that's going to be pretty illustrative, right? I think a lot of these corporate planners are not going to want to give forecasts because, of course, the landscape can change literally as they're speaking. But to the extent, if you're looking at what happened in Q1, we all know that's kind of old news. It reflects probably pull forward. It reflects a totally different dynamic. So it's really about how much forecast information. On the macro front, of course, if we see jobs come in and continue to be strong, it's going to be difficult to expect the Fed to be lowering rates anytime soon. And notwithstanding, the TIF, obviously with the Trump administration, I don't expect May. June is, something of a toss-up. So I think, it really depends on what we hear out of the earnings landscape coming this week.
Scott, it feels to me like we went from a market plunge on high tariffs and this isn't a negotiation message to the market rebounding on this level of China tariffs isn't sustainable, and we have hundreds of negotiations in progress. Between these extremes, have you been able to sift out any truths worth banking on?
Well, John, I think, we've obviously had a decent bounce off these recent lows. And so what we've been trying to do and talk to our clients about, and this is difficult for retail clients, is, they have cash in their accounts. They want to buy stocks with it. They've been hesitant to get in. And, when stocks are down 10 or 20%, you want to act on that. So, in our opinion, you're going to see some better economic growth, not only from the U.S., but probably abroad in the second half of this year. And so really, we've been looking for cyclical exposure. We like industrials, we like energy, we like communication services, we like technology. And on the up days, those are the sectors that outperform, and on the down days, it's all staples and healthcare and a bunch of defensive. So what we're trying to do is try to get a fix on what the economic outlook's going to be. Dana's right. Earnings, that's what happened in the past. You'd like to think you'd get some decent guidance, and certainly our individual company analysts think that some of these companies are going to give us some good guidance. But overall, just these calls, it's like the word cautious or caution or uncertain. Those are going to be used hundreds, if not thousands of times here over this earnings season. And so I think you have to look ahead, try to figure out what the macro environment's going to be. We think it's going to be more cyclical as we move through the second half of the year and in 2026, and position for that.
Okay. I'd add mitigation to the list of repeat words. We've got our first earnings report to bring you. Cadence Design results are out, and Christina Parts-Nevelis has the numbers.
We have a mixed report. So EPS, earnings per share, beat of $1.57, higher than the street anticipated on revenues of $1.24 billion, which we'll say is roughly in line, up 23% year over year. For full year guidance, it's slightly better. This would be full year guidance of 5.15 to a range of 5.23 billion. Non-GAAP gross margins also a little bit higher for Q1 at 41.7. One quote actually stands out to me in this release from the CEO saying, quote, "We haven't seen any changes in customer behaviors at this time as they continue investing in R&D for their next generation designs. Our resilient software business model, strong backlog, and AI-driven product innovations position us well." So this is another company that's saying they haven't seen any changes in customer behavior. Both TSMC as well as STM also had the same sentence, I would say, in their reports as well. And you can see shares jumping over 2% right now, Morgan.
Okay, Christina Parts-Nevelis, thank you. Dana, I'm not going to ask you to comment on Cadence specifically, but just this idea that some of these tech companies, some of the software companies, some of the R&D sort of early design phase, like a Cadence companies, would be saying no changes to customer demand here despite that macro uncertainty. What does it signal about tech in this environment, and especially as we are going into 4 of the Mag 7s reporting later this week?
Yeah, well, so it's been interesting. And I would echo some of the earlier comments. I think we had for a few years there a situation where big tech in particular, had taken on sort of this defensive property where, when it was a risky environment, and it was a risk-off kind of mood in the market, tech would get the assets because it was, you had just good cash returners and kind of companies that could weather something like a COVID. We have such a different landscape year to date where now there's more of a realization, look, these big tech companies and all the surrounding satellite companies are huge CapEx investors, right? Making a big bet on AI, something that's unproven in market yet. And they come into the year with very high valuations. Now, obviously, some of that has come off, but there's still relatively high valuation, still a lot of concentration in the index. And then rather than getting this pro-growth, pro-business sort of a landscape, they've kind of run smack into a jarring amount of volatility. And so I think we've moved back to tech being more of a risk-on kind of a play. And that's not to say it's not the right play, but it certainly has shifted in terms of what the market is expecting from these companies.
Okay, hang tight. We got some more results. F5 earnings are out for fiscal Q2, and it is a beat on the top and bottom lines. F5 reporting revenue of $731 million versus $719 expected. A non-GAAP EPS coming in at $3.42 adjusted versus $3.10 expected. I'll also mention the Q2 non-GAAP gross margin came in above expectations at 83.1% versus 82.8% expected. On the guidance, the range on the top line is well above expectations. 740 to 760 million. That's 750 at the midpoint versus 739 million expected. On the EPS, the range is actually below the expectation. They're targeting an EPS range of $3.41 to $3.53 versus $3.54 expected. I did speak with CEO Francois Locodono. We're going to hear more from him a little later this hour about the quarter. He pointed out they did also raise their full year revenue growth outlook and EPS growth outlook as well. So he stays confident in the trajectory and in the guide here, Morgan. Just being a little cautious as well, but we're going to hear more from him on what's behind the quarter.
Looking forward to that, especially as the stock jumps 3% right now. Scott, I want to go back to the chart of the day from Bespoke, which was published just a short while ago, and in which they say that April is on pace to be one of the biggest upside reversal months in the stock market's history, that if the S&P can rally another 2.3% here before the end of the month, this will be the first time ever that the index has reversed a 10% plus intra-month decline to close higher. Has the move we've seen, given all of the tumult, especially where trade and tariffs is concerned, has it surprised you? Does it change your investing thesis here, especially as you have been really all in on U.S. stocks?
Yeah, I think, Morgan, the fall and how quickly, we were down 20% there briefly in the S&P 500. The fall is what caught me a little bit off guard. I think the bounce higher, makes a lot of sense. But also, and I look at charts all the time, and you can make a pretty good argument that, we could bounce higher from here. But I still think there's a lot of risks out there. Certainly this tariff situation is a very fluid thing. When you talk about, the EU or China, I mean, these negotiations are not going to, happen overnight. And we may see a lot of smaller trading partners come. We may have conclusive deals, which I think the market would like. But then, think about the month of May. House Speaker Johnson wants to have a bill on the president's desk by Memorial Day for him to sign on the budget. I mean, that's a tall task, and we're going to hear a lot of news about that in coming weeks. That's a risk. People are still going to be concerned about growth. I think this data that's out this week, whether it's PCE or orders for durable goods or the ISMs or the labor report on Friday, I mean, these are all critical reports that are going to help people gauge what's going on with growth and what we can expect from these corporate earnings, because certainly there's going to be a haircut relative to where you thought earnings were at the beginning of the year, and it's just a matter of how much. So, what we think is, you're going to see a slow quarter or two here, but a reasonable, not a great bounce back, but reasonable activity that people are going to be more optimistic about as we move through the second half of the year. That's what we want to position for.
Okay. And of course, we get something like 40% of S&P companies reporting this week. So peak earnings week for us to sink our teeth into. Scott Wren, Dana Dioria, thank you both for kicking off the hour with us. It was a mixed day for stocks. The NASDAQ finishing fractionally lower. The S&P fractionally higher. 55.28 is where it looks like we've settled here. Now let's bring in CNBC's senior markets commentator, Mike Santoli, for a look at the market's attempt at this rebound this month. Mike.
Yeah, Morgan, made up a lot of ground, and actually the low-end stocks for the S&P 500 somewhat coincided with a bit of a peak in that whole Sell America theme that was pressuring bonds like treasuries as well as the dollar. And so here I wanted to plot the U.S. stock market, obviously in orange, the S&P 500 is a 6-month chart against all the countries in the world outside the U.S., the all-country world index ex-U.S., and you see the angle of recovery is somewhat similar. But you see the rest of the world much closer to its highs and still holding this outperformance. So, usually they're going to move more in line than not, at least in direction, if not in magnitude. But it is definitely interesting that the non-U.S. outperformance has persisted. And in fact, I don't show up, but on a one-year basis, neck and neck, even after the U.S. was way ahead during the Mag 7 boom. Take a look here, another little intermarket relationship, gold versus the NASDAQ 100. Now, this is a 1 year. You see, they were more or less aligned until a couple of months ago. Massive jump in gold. We know that. It was like the one diversifier trade that was working. A lot of panic about policy. But this is what's more interesting to me is the reversal to the downside in gold coinciding with this bounce we've seen in the NASDAQ 100 stocks tells me two things. One, the risk-off trade maybe overshot a little bit, but also they can come closer together without it necessarily being a trend change because they gapped out so much. So I think there's a pretty decent burden of proof still on the mega cap U.S. tech stock recovery here that it's anything more than a reflex rebound, guys.
I'd be curious to see how Bitcoin fits into that last chart you're showing, because we've heard the comparisons.
It's pretty close to gold.
There you go. I was going to say, because we hear it compared to NASDAQ and we hear it compared more recently to gold, too.
That's right. So, yeah, the dual nature of Bitcoin, is it digital gold or is it just a tech proxy? It has over a 1 year, 6 month basis. It's actually now caught up to gold. It was lagging for a couple of months there and is now sort of popped back up there. And that maybe is more consistent with the reawakening of risk appetites we've seen in stocks as well.
Market commentary has highlighted 50% retracement of the down move from the February peak. We've got an S&P just below that 2%. From the Liberation Day tariff announcement, and S&P back above 20 times price to earnings. We've got multiple asset classes that are not close to pricing in a recession, and we've got hedge fund selling versus retail dip buying resilience. What is this market signaling at the end of April, and what has changed so much since the beginning when we did have those initial tariff announcements?
I mean, most of what it's telling you is that we obviously had a very disorderly complete stampede out of risk assets in the very early part of this month that culminated April 7th, and we've kind of unwound some of that. So just in terms of the basic kind of physics of the market, you get a big major low. The market was down 20% in 7 weeks. It's an unusually fast decline. So the fact that we recovered and essentially said, okay, we're no longer going to price in the worst case scenario for tariffs, but at this level of valuation, at this level of the index relative to where its trend is, it probably takes a little bit more affirmative, reassuring news as opposed to just the absence of the worst case scenario to get us a little bit further. But, a lot of the things about this rally have been very constructive. It's been really broad, and it did clear a couple of hurdles on the way to that 50% recovery, as you mentioned.
Okay. Mike Santoli, thank you. We'll see you later this hour. We got much more earnings action on the way, including results from NXP Semiconductors. Star analyst Stacy Rascon gives us his first reaction to those numbers next.
Now we'll see why it's down 5%, and we will hear from the CEO of Cloud and application delivery company F5 before his call with Wall Street analysts. Overtime's back in 2. Welcome back to Overtime. NXP Semiconductor earnings are out. Christina Partsinevelos has the numbers. Christina.
Well, we're seeing a beat for both earnings and revenue. $2.64 adjusted earnings per share with revenue of $2.84 billion. Their automotive segment continues to be their powerhouse, making up almost 60% of their business. But revenues did come in a little bit light at $1.67 billion. Their non-GAAP gross margins also a little bit light for the quarter. And interestingly, for Q2 guidance, EPS was in line. Q2 guidance for revenue slightly higher. The big change, though, the company announcing a change of management. CEO Kurt Sievers is going to retire at the end of 2025. NXP's board of directors announced that it has unanimously approved Mr. Rafael Sotomayor to succeed as president effective April 28th, 2025. They're both going to work together to orchestrate a smooth leadership transition until mid or end of October. There's one line that stuck out to me in this release coming from the current CEO, taking more of a cautious tone, saying, quote, "We are operating in a very uncertain environment influenced by tariffs with volatile direct and indirect effects." So you've got a CEO change and then obviously concerns about tariffs weighing on the stock right now, down over 5%. Guys?
All right. Christina Partsinevelos, thank you. For more on NXP, let's bring in Bernstein senior analyst Stacey Rasgon. Stacey, great to have you back on the show. Let's start right there. Your reaction, your initial reaction to NXP.
Yeah, I mean that's kind of what it is. The revenues were kind of in line-ish, although as she said, auto and actually even industrial were a little light relative to consensus. Beats on mobile and comm, which I think are less attractive. Gross margins just a hair light both in the quarter and in the guide. Channel inventories actually went up a week. They're at 9 weeks, so some of the revenue actually was shipping into the channel. And again, we have the CEO transition amid a period of uncertainty. It's probably not enough. I'm not surprised the stock's down a bit.
Are you surprised that the commentary here, at least that we've gotten in the release, is so different than what we got from Texas Instruments last week?
Well, maybe not. I mean, TI tends to call it like they see it. And like as of right now, you have to remember TI has effectively 100% availability of 100% of their parts. It's very possible that there's pull forward and other things in the wake of tariffs. And, you know, TI, frankly, like cyclically, they were probably starting from a lower point. So they're sort of calling for upside on the back of cyclical recovery. The problem is, like, from the company standpoint, they probably don't know the difference between cyclical recovery and pull forward. They wouldn't be able to see. All they see are the orders in front of their face. And to be honest, TI probably doesn't care. Like, if they can fulfill it, they'll ship it. Like, that's just how they run their business. NXP runs things a little bit differently.
Stacey, the stock's dropping here in overtime, down about 6.5% right now. And I can't help but wonder, A, is this an expected CEO transition? And B, might they be talking down the future a little bit more than they might otherwise to ease the CEO transition? I mean, no new CEO likes to come in with the bar set too high.
Yeah, this was not an expected CEO transition. No, I'm a little surprised. Like, Kurt, I don't think Kurt's that old, but he has been at NXP, I guess, for 30 years. He's pretty well liked among the investment community. So no, it's kind of a surprise. I don't actually know why that transition's happening. You're right. Clearly, you know, they like to set the bar. Although, to be honest, they guided revenue actually a little bit above where the street is. So it's not so much in the near term that they're lowering the revenue bar all that much. In terms of the commentary on just uncertainty and no visibility, I think that's accurate. I don't think anybody has any visibility, especially into the second half right now.
I'll note again, the release does say Mr. Sievers' departure is purely personal decision, not related to any disagreement with the board of directors or any issues relating to the strategic or financial performance of the company. But this is a company that is strongly levered to the transformation of autos, not just in self-driving, but also entertainment internally, just more becoming a cloud-connected computer. And with the looming threat of tariffs and uncertainty over how much cars are going to cost, is this well priced at this discounted level after this overtime move?
Well, I mean, it is cheaper than some of the other, say, analog names in my coverage. I wouldn't say that it's cheap, but it's cheaper than some of the other ones. The question, though, is going to be, as always, you know, everything can look cheap on price to forward earnings, but you never really know what the E is, right? And so that's where that uncertainty comes in. It'd be very interesting to see what they say. We'll get more commentary directly from them in the morning when they actually have the conference call.
Yeah, the counter argument to NVIDIA being a high grower, but also not necessarily expensive. Stacey Rasgon, heard you say that many times. Thank you. Well, let's get another check now on F5 networks. It is off the highs, now up about 1%. Just reported earnings moments ago. I spoke with the CEO, Francois Locodonu, about these results. He pointed out the outperformance in hardware specifically and how most businesses that went all in on the public cloud a few years ago and their customers are F5 are now pivoting to hybrid, which benefits F5.
Hardware was up 27% year on year. And part of that, of course, is we're seeing very strong momentum in tech refresh with customers that had not been able to refresh, in the last 12 to 18 months. But if you dig deeper, it's so much more than that. We're seeing strong traction in companies reinvesting in their data center, modernizing their data center, and expanding their data center capacity. We're seeing tailwinds from AI and companies getting their infrastructure to be ready for AI. And lastly, we're also seeing very strong momentum displacing traditional competitors and continuing to gain share in the application delivery and controller market, which is our core market. A lot of companies went cloud first several years ago and moved a lot of applications to the public cloud. What we've seen over the last several years is 80% of organizations that moved applications in the cloud actually have repatriated some of these applications.
Now, I did ask him about tariffs. He said they're not seeing a tariff impact on demand right now. Also said that F5 supply chain is well diversified and positioned, doesn't expect an impact there based on what we know. And he's expecting a strong second half for the software portion of their business, but he's still, positioned the guide with some wiggle room.
All right. Well, investors like it right now with the stock up 2%. When we come back, BlackRock's Gargi Chowdhury just published her spring investment outlook, and she says more volatility is coming. She will break down how to navigate it next.
And global investor Mark Mobius tells us where he's finding opportunities in the world right now, how to trade China, India, and more. We'll be right back.
Welcome back to Overtime. It's been a month of extreme volatility in the markets, and it may not settle down anytime soon. That's according to a new spring outlook report from the world's largest asset manager, BlackRock. Joining us here on set is the author, Gargi Chowdhury, BlackRock head of iShares Investment Strategy Americas. It's so great to have you on the show. Welcome.
Thank you. It's good to be here. Long-time listener, first-time joiner.
Well, we're happy to have you, and we want to break down this report because we are talking about economic uncertainty. We are talking about very dramatic volatility across a number of asset classes. How do you navigate that going into the rest of the year?
Absolutely. So a couple of things that we've been hearing from our clients and your listeners, I'm sure, is number one, if this volatility persists, how should we think about positioning our portfolios? Should we be moving to cash, which is the question that's topmost? And the second one is some of my traditional hedges haven't worked. So historically, if you've used long duration bond markets as a hedge for your equity markets, you saw some periods in April where that didn't work. So what should we do about that? So our spring investment directions is trying to answer those questions. Number one, stay invested in the markets. We saw the volatility. We saw how quickly it moves in both directions. So make sure you don't leave the market, but maybe move to some of the more, what we call the more defensive minimum volatility parts of the market that will give you a little bit better protection because of that lower volatility. And second, think about diversifying your diversifiers. So where you might have had long duration treasuries before, maybe think of a combination of the front end of fixed income markets, focus on income, think about gold, think about liquid alternatives that are more market neutral in nature. So that's what we've been talking about with our clients.
Has the definition of what's safe haven or what's defensive, has it changed in this environment? I mean, you just talked about long duration treasuries. I mean, typically, especially if you're concerned about slowing economic growth and uncertainty, that would perform well. It hasn't. We know bond vigilantes are back in a big way right now. So do we have to think differently about what constitutes safe in this environment?
I think a little bit. I think it's a little bit more nuanced in a world where you're seeing equity markets go down at the same time as bond prices, at the same time as the US dollar. I think that trifecta has really surprised many investors. And I do think you have to think harder about adding an additional layer of diversification in your portfolio. So for example, we look at US investors, US advisors' portfolio, and what we're finding is often more than 50% of them, more than 70% of them have a huge underweight to international markets. In a world where we might have seen some of the peaks of the US dollar, maybe it stabilizes here, maybe it continues to go lower from here, can we get some benefits in international investing? We think so. So we're telling investors, add international here, add some European value here, we think. And another big theme that comes up a lot is the long end. As you mentioned, the long end of fixed income markets. That hasn't worked really for some time now, but certainly in 2025, that hasn't given you the diversification. So really focus on the belly of the curve and focus on income. We tell investors to move to strategies like BINC, which gives you that income in the belly of the curve with very little interest rate risk.
I want to go back to international.
Yeah.
Within the lens of China and India, because those are those two big billion population plus influencers. And as an investor, I've for a while felt like China and India tend to be easier to invest in the demographics from a fund perspective than, say, Latin America, the types of companies, et cetera. But they're each having issues. China with the demographics, India right now with a conflict and stability. How should investors approach the whole thing with that lens?
Yeah, absolutely. So we, in our outlook, we talk a little bit about, sort of reducing your volatility even when you're in the EM markets and focusing on minimum volatility EM solutions. And then we talk about another area of the world which is often overlooked in portfolios, which is Latin America. And we think that in this bifurcated, geopolitically fragmented world, can we find some opportunities, especially obviously volatility around, if the world goes into a recession, Latin America will not be saved. But if we stabilize for a little bit, can you find some benefits towards looking at some of those areas which may significantly benefit from the rewiring of supply chains, as well as being, from a valuations perspective, being cheaper?
So many LATAM funds that I look into are full of utilities and staid banks. And I really wonder, can an investor get the full economic potential benefit of some of these locales with the way these funds are constructed.
Yeah, I think so. And again, being very cognizant of diversification in this environment is important. So I'm not saying take all your portfolio and move it to ILF. You're not supposed to do that, or move it to Mexico. No. But to the extent that you've had U.S. only, and perhaps you've been considering adding some diversification, and historically you've only thought of Europe, why not consider, in addition to Europe, why not consider a fund such as, the one that I just mentioned, ILF, or even just focusing on Mexico or just Brazil? We think that makes sense. And I also want to point out that, you brought up demographics. I think there are other broader, themes that are going to persist in the markets, and I think we learn more this week with earnings. But AI as a theme hasn't gone away. We've talked less about it. I think we will in the weeks to come. But maybe this provides an opportunity. It provides a backup. The backup in prices provides an opportunity for you to get back into some of those themes that will be with us for years to come.
All right. Well, we like to talk about AI a lot here on Overtime. So Gargi Chaudhry, thank you.
Thank you.
Well, it's time for a CNBC News update with Julia Borston. Julia.
John, power is returning sporadically across Spain and Portugal after a massive outage immobilized many areas, including capitals Madrid and Lisbon. Spain's grid operator said more than a fifth of the country's power was restored, while Portugal's power company said 2 power plants were back online. Witnesses in Lisbon and Madrid tell Reuters that the lights are coming back in some areas. Spain's Interior Ministry has declared a state of emergency. The exact cause of the outage is still under investigation. Virginia Congressman Jerry Connolly announced today his cancer has returned and he's leaving the House at the end of this term. In his announcement, the 8-term Democrat, who was originally diagnosed last year, said he will also step down as the ranking member of the Oversight Committee. And New York City's congestion pricing toll raised $159 million in revenue in its first 3 months. That's according to data from the MTA today, which also showed nearly 6 million fewer vehicles entered the toll area. The Trump administration has claimed the toll is illegal and given the MTA until May 21st to end the program. Back over to you.
Julia Borston, thank you. We've got Nucor earnings out, and Pippa Stevens has the numbers. Hi, Pippa.
Hey, Morgan. Top and bottom line beat here for Nucor during Q1. EPS coming in at 77 cents adjusted. That was 13 cents ahead of estimates. Revenue of $7.83 billion, also ahead of the $7.23 billion that Wall Street was looking for. This was against lowered guidance after the company did issue preliminary results back in March. Now, for Q2, no specific numbers, but the Nucor said that they expect earnings in the second quarter to increase across all 3 of their operating segments. Stock down here about 1%. Guys?
All right, Pippa, thank you. Coming up, China-based EV maker BYD just unveiling a new piece of technology that it hopes will set it apart from Tesla. We got a first-hand look at this potential game changer ahead.
And after the break, what the swings this month in the junk bond market can tell us about the odds of a recession. Overtime, we'll be right back.
TradingView.com.
Welcome back to Overtime. Mike Santoli returns with a look at whether recession fears might be fading.
Yeah, they might be becoming a little more muted, John. Take a look at the Citi Economic Surprise Index. It shows you how economic data are coming in relative to forecast. It's bounced in the last 2.5, 3 weeks. This is around the time the U.S. equity market started to bounce, too. Right up to the zero line, though. So it's not as if we're seeing acceleration or outperformance by economic data, but a little bit better. We know the survey data have been really weak. Hard data, a little better. Take a look at the junk bond market. This is the spread on high-yield debt. It's shot higher to pretty alarming levels, actually something that would have suggested a high alert for a recession. Now it's plunged right back down. However, we're still at last year's high. So, again, we're on alert for further weakness, but right now back from the brink in terms of the most panicky fears, guys.
All right. Mike Santoli, thank you. Up next, emerging markets investor Mark Mobius, and where he sees the biggest opportunities to invest around the world during this trade war.
Plus, Eunice Yoon looks at a potential new problem for Tesla from one of its Chinese rivals. When we come right back.
China's BYD hopes that this will be a game changer for the EV industry, a public charger that helps you fuel up as quickly as at a gas pump. More in a few minutes.
Business.
Welcome back to Overtime. A new technology is being unveiled that could be a game changer for the EV industry, and it could be a threat to Tesla. Eunice Yoon explains.
We're at one of BYD's more than 5,000 mainland Chinese stores. The company is the market leader when it comes to EVs in China. It's known mainly for its low and mid-priced cars, like this one is about $10,000. But now the Tesla rival wants to press home its advantage with new advanced technologies.
Like this super-fast megawatt charger.
BYD claims that with certain models, like this Han L, you could charge up as quickly as you would filling up at a gas pump, 250 miles in 5 minutes.
That's faster than Tesla's 200 miles in 15 minutes. At the moment, BYD's flash charger only operates with specifically designed power systems and is available just for 2 of its own models in China. However, the company says 500 are already built, with plans to roll out 4,000 across the country. In addition, BYD has a new system that allows a car to use 2 plugs to charge up at once. The company hopes to run its competition off the road with autonomous driving, too.
BYD says that it wants as many people as possible to use its self-driving technology, so it's offering it for free.
This Denza Z9 is equipped with an advanced version of BYD's D-Pilot driver assistance program, or God's Eye in Chinese. With a click, it's capable of navigating the vehicle through China's crammed city streets on its own. The system, though, does require drivers keep their hands on the steering wheel and disengages if they don't.
Another standard smart feature, helping drivers maneuver in tight spaces. Using this screen, I can angle the rear of the car to scooch in the small lane.
Tesla still doesn't have its full self-driving technology approved here in China, but by setting its own service at the value of it at zero, BYD makes it that much more difficult for Tesla or any other competitor to charge for their service. John?
All right, an important wrinkle there in the market. Eunice Yoon, thank you as always. And for more on China and emerging markets, let's bring in Mark Mobius. He is chairman of Mobius Emerging Opportunities Fund. Mark, always good to see you. So we've talked a lot about China versus India here, but the world has changed since the last time we went deep there. How do you see it?
Well, India is still the story. India is doing very well, and I believe India is going to be benefiting from what's happening with China and the U.S.
How so? How so? I mean, I know we talked about Apple and some shifts there, but beyond that, what do you see?
A lot of other things. A lot of manufacturing requiring high labor input would go to India, obviously, because India's got over 1.2 billion people. So that's one point. The other point is that India is gradually coming to an agreement with the U.S. on tariffs. I believe they will reach some agreement. And when that happens, that, of course, will be very positive for India.
Do you see opportunity for Latin America?
To some extent, but not as much, because Latin America, for some reason, has not stepped to the plate in terms of manufacturing and in terms of coming to the table and opening up their markets. As you know, Brazil is the largest country, but it has a very closed market. So I think it'll be more difficult for Latin America to do anything in that direction.
Mark, just to go back to India for a moment, the fact that tensions seem to be ramping and pretty quickly here between India and Pakistan, with just this afternoon reports from the Pakistan defense minister saying that military incursion by India is imminent. How real is that risk to investing in that country right now? And how does it speak to, perhaps more broadly, the geopolitical risk that's being navigated?
Well, that has been always a risk because, as you know, relations between India and Pakistan have never been good. And, of course, they're both nuclear powers. So this is something we have to watch carefully. But even more importantly than that is the tension between India and China on the border in the north. So I believe these tensions will be there, but I don't think it's going to have that much impact on India's ability to export, import, and manufacture. It's too big a country to be harmed by these kinds of issues.
How about China? Because we know the domestic economy there has struggled. And I've spoken to a number of CEOs with big business there who have said they're seeing green shoots. But amid this U.S.-China trade war, tariff war, I think one of the pieces that perhaps is getting overlooked is just how much negotiations between the U.S. and other countries around trade right now are sort of aimed at ring fencing China in. And I'll give you an example. Indonesia has apparently put forward a proposal to the USTR, and it hinges on two key points. The first is that Indonesia will lower the trade gap with America and bolster U.S. imports. But the second is that Jakarta will reduce imports from other countries. They import a lot from China. If we see more of these types of deals struck with the U.S., how great is the risk for China?
I think China is in very bad situation because the target by the U.S. is China. There's no question about that. And a lot of the practices that took place previously under the World Trade Organization were violated time and time again. And I believe at the end of the day, China is really going to be in trouble unless they're willing to come to the table and concede an awful lot. I'm afraid that given the current political structure in China, they will not be willing to do that. And that is not a very good sign. So I believe at the end of the day, other countries like Indonesia will open up their markets, will reach agreement with the U.S. Of course, the danger there is transshipments. The U.S. is going to watch very carefully any transshipments of Chinese goods going through Vietnam, Indonesia, and all these other countries will be severely curtailed.
Okay. Mark Mobius, as always, thank you.
Thank you.
Well, up next, a trio of top tech executives reveal how they're using AI to help stabilize their businesses in a time of instability brought on, in part, by the global trade war. Be right back.
.com.
As geopolitics scramble supply chains, cast revenue projections into doubt, companies are turning to technology for insight and stability. That was the subject of my recent conversation with members of CNBC's Technology Executive Council. Glenn Allison leads enterprise AI platforms, a Tractor Supply company whose customers include rural and agricultural communities. He said AI allowed the retailer to more quickly position key resources during Hurricanes Helene and Milton.
Understanding weather patterns, where is there flooding, where is it that we need to get generators, gas cans, tarps, other emergency supplies into those local communities. And at a time when many other locations were closed, we were available to support the local community. And so, advanced kind of AI platforms that can enable merchandising, supply chain, marketing, store operations, tech teams to move very quickly, with speed, all centered around the customer.
Darlene Williams is Chief Information Officer at Rocket Software, whose products serve critical functions across mainframe and hybrid cloud. She said the company's AI is helping legal teams inside and outside Rocket save time, which is money.
Our legal team uses that solution with AI built into it to scan contracts and find key information about contracts. That's important. Pricing, right? As we were thinking about price impacts. So our legal team at Rocket Software uses that solution. And because of it, they were able to reduce their contract review time by 80%. So that has a real meaningful impact on our business and in the way that we can deliver services.
At PwC, Chief Global AI Officer Joe Atkinson says the firm has begun to advise clients to look beyond cost savings and into deeper employee empowerment as a lever technology can provide.
Now you look forward and you say, what can I do differently with AI that I couldn't do before? And this point of innovation, I think, is so important. When we talk about what you can control and what you can't control, one thing you can't really control is innovation, but you can empower it, you can encourage it, you can seed it all over the organization. And from my perspective, that is really, and this is where we're counseling clients every day, that's about bringing that upskilling, helping people understand the power of these tools, and really unleashing them to think about how these tools can change the way they work every day.
CNBC's Technology Executive Council is a membership organization for C-level technology executives from any industry. I've started a series of tech talks to pick their brains about how they're tackling various challenges. If you'd like to apply for membership, head over to cnbccouncils.com/TEC.
Well, up next, all the overtime earnings movers that should be on your radar and the big reports that could move the market tomorrow. There are a number of them, including for Dow stocks. Welcome back. Let's get a check on today's overtime movers. NXP Semiconductors is falling after the company announced its CEO is retiring. Also reported light auto revenue and light gross margins. Those shares are down 7% now. Meantime, shares of American manufacturer Leggett & Platt are jumping after the company reaffirmed guidance, saying tariffs may be a net benefit for the business. Those shares are up 15.5%. Industrial manufacturer Woodward is higher after beating on earnings and revenue, saying it's confident in its ability to mitigate the impact of tariffs as well. Those shares are up 4.5%. But the earnings parade, it's just getting started. It speeds up tomorrow when Dow Components, Coca-Cola, Honeywell, and Sherwin-Williams report before the bell. UPS and GM are also out in the morning. And then during overtime, we will break down results from Visa, Starbucks, Mondelez, Snap, and Booking Holdings.